Since technical analysis can be used with all markets and time frames, this chart example will remain nameless for now. This can be a chart from any market or time frame. The identity of this chart will be revealed later, but first it will demonstrate the idea of swing points in this case study. Swing points, or reversal points, as they are sometimes called, are just that. Areas on the chart where price changes direction. For instance, on this chart, there are two clear down swing points near the 55 level. Swing points naturally form around areas of support and resistance. These are contentious areas of interest to both buyers and sellers. The market was taken over 55 following a large influx of green bullish volume, which soon subsided, resulting in a weakening of the steepening uptrend and the current downswing forming. It's natural for this prior 55 resistance to reverse rolls and offer support to falling price. Support can hold price from falling further and potentially reverse it back up on an upswing if there is an influx of green bullish volume, such as what was seen earlier. Currently, there is less incentive to sell at the 55 level because of recent trading activity at or slightly below 55. Selling now would drive down price below 55 and would result in losses beginning for the recent concentration of buyers at these swing points and the break over 55. So in the short term, there was certainly an imbalance with less incentive to sell and some incentive to buy. But in the bigger picture, it is important to remember the market recently reached a high at 57 and was driven down relatively easily with some minor spikes in selling, which has begun to re-emerge. The recent upswing had normal to slightly above normal volume, and that is okay in the very short term, but not as significant to continue the longer term uptrend, such as the larger amount of green bullish volume seen earlier when breaking over the clear 55 resistance. And on a side note, going to the bottom left corner, there is volume and 20 beside it to mean the average volume over the past 20 trading sessions. Each candle and volume bar represents one session, and this average volume over the past 20 trading sessions is represented by the purple or bluish color over the red and green volume bars. It's just a simple visual way to see normal volume and when the market significantly increases to high or low levels of volume. It's commonly an average of 20 in most all markets. For example, the stock market on average is open 20 days a month. And in shorter time frames, in the intraday or longer time frames, such as weekly or monthly charts, 20 also gives a good balance between long-term context and short-term developments. That's just in case you were wondering about the volume down here. Back to the case study with the chart now showing very volatile movement in the short term, rapidly moving back down towards 55 with increasing red volume spikes. A downtrend is certainly developing with these recent down swings. However, the support around the 55 level is still holding the market from falling further. The 55 support is not guaranteed, especially with the large rebalancing back to a more bearish stance, as evidenced by these large drops in price along with more red volume spikes. There is increasingly more incentive to sell because once the market begins going below 55, a large concentration of recent market participants that bought earlier at or below 55 will begin losing. Here we also see the importance of swing points as an approximate area or price range rather than an exact level. There will never be an exact price level down to the decimal as the market is dynamic, but rather it's more accurate and useful to think of a price range centering around a particular price level that will offer support or resistance. An increase in selling pressure resumes to decisively move below 55. To show this was more of a temporary pause around the 55 support, and now it is likely the next support will be around 52, as it was the site of a major upswing in the recent past. Though it is helpful to keep in mind the longer-term perspective of resistance and the developing downtrend, along with potentially more significant support areas at lower ranges. The downtrend accelerates with increasing selling volume, and that is essentially a more rapid repeat of what happened at 55. There is a very brief pause at 52 prior to moving lower. But remember, a steep trend, whether it be an uptrend or downtrend, is unlikely to be sustained for an extended period, especially as volume subsides, and a swing point forms at an established long-term support, in this case 49. 52 now demonstrates a case where a former support now offers resistance to rising price. Eventually 52 is surpassed, with closing well above the short-lived flat phase. Volume is not exceedingly high, though it is very consistent and is more than adequate to overcome the shorter-term resistance, especially with the near absence of selling pressure, which can easily be observed with more green than red appearing on the chart in the short term. The uptrend continues to develop, and eventually the mid to upper 50s are reached, and as would be expected, there is resistance re-emerging once more. Also, this is revealed to be the consumer staples sector ETF, ticker symbol XLP, during the late 2017 to early 2019 period, and it is a daily chart, with each candle and each volume bar representing 1 day's worth of price action. But in the end, it doesn't matter which chart it is, the key features of swing points are demonstrated. Often, swing points, especially recent ones, will have influence over upcoming resistance and supporting areas. We've also seen the concept of role reversal, where resistance can become support and support can become resistance. Also, notice the drastic shifts in volume that can occur when price reverses or a resistance or support is passed. Also, support and resistance ranges of greater importance are normally formed near swing points that reversed price in the long term, such as the 49 level, when compared to shorter term swing points that formed areas of lesser significance, such as the 55 level, which was more of a short-term area when compared to 49. And even though certain swing points can present strong potential support or resistance, nothing is ever guaranteed, especially if there is adequately strong volume to cross a barrier, such as when the steep downtrend accelerated to easily cross below 52, and when major increases in volume are not sustained. Major levels of support and resistance can still be crossed if there is adequate volume, such as during this steep but relatively strong uptrend that developed from quite consistent green bullish volume that wasn't exceedingly high for long periods of time.